For decades, silver has occupied a strange position inside the financial system, treated as both an industrial input and a monetary relic, yet rarely granted the seriousness reserved for other strategic assets. That ambiguity has allowed distortions to accumulate quietly, largely ignored until moments when stress begins to surface in places most investors aren't watching. Recently, analysts like Michael Oliver have pointed not to headlines or price spikes, but to structural signals that suggest something far less visible is tightening beneath the surface, and that tension hasn't resolved itself yet. What makes this moment different isn't a sudden surge in demand or a single dramatic event, but a pattern that's been forming across futures markets, physical inventories, and positioning data. Available market behavior implies that silver's price has been held within boundaries that no longer align cleanly with underlying pressures. Short positions, long treated as routine tools for liquidity and hedging, appear increasingly crowded relative to deliverable supply, creating a mismatch that doesn't announce itself loudly, but rarely corrects gently either. At the institutional level, silver shorts are not emotional bets. They're structural assumptions embedded in models, balance sheets, and risk frameworks. These positions persist because they've worked for years, reinforced by volatility that tends to punish anyone who challenges them too early. Yet Oliver's warning isn't about timing a rally. It's about recognizing when those assumptions begin to strain, when the cost of maintaining control starts to rise faster than the market expects, hinting at retaliation rather than release. What's unsettling is how little margin exists for error once that balance shifts. In markets where leverage is normalized, small price movements can trigger mechanical responses, not strategic ones. Reports suggest that if silver pushes through certain technical thresholds, forced covering could accelerate independently of broader sentiment, turning what looks like a contained market into one reacting to its own internal constraints. That possibility remains theoretical for now, but the setup doesn't disappear just because it's uncomfortable. The deeper concern isn't whether silver moves higher, but how the system responds if it does so without permission. Short squeezes aren't born from optimism. They emerge from rigidity, from positions that can't adapt quickly enough when conditions change. Oliver's framework suggests that silver may be approaching such a point, not because of hype or speculation, but because the structure supporting suppression is beginning to show signs of fatigue. And if that fatigue becomes visible, the response may not be orderly, gradual, or easily managed, raising questions about who is prepared to absorb the consequences when pressure stops building quietly and starts expressing itself openly. For decades, markets have relied on the assumption that pressure can always be dispersed over time, that liquidity will appear when it's needed, and that extreme outcomes are anomalies, rather than features of the system. Silver has benefited from that belief more than most assets, allowing imbalances to persist without immediate consequence. But structural data increasingly suggest that this patience may be running out, and when it does, the response could come from places that aren't designed to slow it down. One of the more overlooked elements in Oliver's warning is how silver behaves during periods of broad market stress. Historically, it doesn't move in isolation. It reacts to shifts in risk appetite, currency confidence, and interest rate expectations, often lagging at first before catching up abruptly. That lag creates a false sense of stability, masking the buildup of energy beneath the price. By the time silver begins to move decisively, positioning data often shows that exits are already crowded, leaving little room for discretion. What complicates matters further is the role of paper markets in defining silver's price. Futures contracts and derivative structures have long dictated price discovery, even as physical availability tightens unevenly across regions. Market behavior implies that this separation between financial exposure and real metal has grown wider, not narrower. When price is set by leverage rather than scarcity, the adjustment, if it comes, tends to be sharp rather than smooth. Institutional traders understand this risk in theory, but systems are slow to adapt when the old framework continues to function just well enough. Short exposure remains viable until it suddenly isn't, and when that line is crossed, covering becomes less about valuation and more about survival. Oliver's analysis points to technical levels where this transition could occur, not as a prediction, but as a warning that the market's tolerance for imbalance is finite. There's also a geopolitical layer, quietly reinforcing these pressures. Industrial demand, tied to energy infrastructure, electronics, and defense applications, doesn't respond to price signals in the same way as speculative capital. Once procurement schedules are set, demand becomes relatively inelastic. If financial markets are forced to reconcile that reality with constrained supply, price mechanisms can behave unpredictably, especially when short positions dominate the narrative. What's notable is how calm the surface still appears. Volatility remains contained, headlines remain distracted elsewhere, and silver continues to trade as if these tensions are theoretical. That calm is precisely what allows leverage to accumulate unchecked. When the reaction comes, it rarely announces itself in advance, leaving participants to respond in real time to a shift they can no longer model away. And as that possibility grows, the question isn't whether silver can be controlled, but how much strain the system can tolerate before control itself becomes the catalyst. For decades, the mechanics of market control have depended less on conviction and more on continuity. As long as participants behave predictably, stress can be absorbed, rolled forward, or deferred. Silver's market has leaned heavily on that principle, with short exposure layered and relayered under the assumption that time itself is a neutral ally. What Oliver's work suggests is that time may no longer be neutral, and that persistence could be turning into vulnerability. One reason this matters now is the changing character of participation. Large funds, banks, and commercial hedgers still dominate volume, but their flexibility has narrowed. Regulatory constraints, capital requirements, and internal risk limits mean that exits are no longer purely discretionary. When positions move against them, responses are increasingly automated, governed by thresholds rather than judgment. In a market as thin as silver, that shift can transform ordinary price movement into something self-reinforcing. There's also evidence that the traditional shock absorbers are weakening. Options markets, once used to smooth volatility, appear less willing to warehouse risk during periods of uncertainty. When volatility is underpriced, sellers disappear quickly, leaving fewer buffers between price and forced action. Oliver's analysis doesn't assume panic. It highlights how calm conditions can lull participants into underestimating how quickly those buffers evaporate once stress appears. Physical flows add another layer of tension. While futures markets can expand and contract exposure instantly, physical silver moves on slower timelines. Mining output, refining capacity, and transport logistics don't adjust to price signals in weeks or months. If financial pressure forces rapid repricing, physical supply can't respond in kind, creating a feedback loop where scarcity reinforces financial stress rather than relieving it. What's particularly striking is how little of this is visible in mainstream narratives. Silver remains framed as a minor asset, a sideshow to larger monetary debates. That perception itself becomes a risk, because it delays scrutiny until the adjustment is already underway. Markets rarely correct in proportion to attention. They correct in proportion to imbalance, and silver's imbalance has been building largely out of sight. As these layers intersect, automation, constrained liquidity, slow-moving supply, the margin for error tightens. Control doesn't vanish all at once. It erodes, step by step, until a single move reveals how little room remains. For decades, confidence in market resilience has rested on the belief that price discovery can be managed without destabilizing the broader system. Silver has been a beneficiary of that belief, kept within ranges that suggest balance even as underlying conditions shift. Oliver's warning challenges that assumption by focusing on what happens when control mechanisms themselves become sources of pressure rather than stability. One overlooked factor is how tightly silver is interwoven with other markets that don't share its liquidity profile. When capital rotates through currencies, bonds, or equities, silver often absorbs residual stress indirectly. That spillover isn't immediate, but it compounds. Market behavior implies that silver's price has been absorbing external pressures without fully reflecting them, a condition that can persist until correlations snap rather than bend. Another layer comes from the psychology of positioning. Long periods of containment teach participants to fade moves and sell strength, reinforcing the dominance of short exposure. Over time, that behavior becomes reflexive. The risk emerges when the market stops rewarding that reflex. Once rallies no longer reverse quickly, confidence erodes, and the same positioning that once suppressed volatility begins to amplify it. Oliver's framework suggests that this shift doesn't require a dramatic catalyst. It can begin with a modest move that fails to retrace, forcing reassessment across desks that are accustomed to mean reversion. As those reassessments occur simultaneously, liquidity thins and price becomes more sensitive to marginal flows. What looks small on a chart can feel much larger in execution. The implications extend beyond traders. Institutions that rely on silver-linked instruments for hedging or pricing inputs may find that assumptions embedded years earlier no longer hold. When volatility increases in a market assumed to be stable, secondary effects ripple outward, often surfacing in places that appear unrelated at first glance. What keeps this fragile is the absence of a release valve. With leverage elevated and physical supply slow to respond, there's little room for gradual adjustment. Pressure either dissipates quietly or it seeks an outlet through repricing. And the longer that repricing is delayed, the more abrupt it tends to become when it finally arrives. The question now isn't whether silver can remain constrained, but whether the cost of maintaining that constraint is approaching a level the system is no longer willing to pay. For decades, silver's subdued behavior has been interpreted as evidence of equilibrium, a sign that supply, demand, and speculation are largely in sync. That interpretation becomes less convincing when examined through the lens of stress accumulation rather than price alone. Oliver's analysis places emphasis on what hasn't happened yet, on movements that failed to materialize despite conditions that historically would have produced them. One signal comes from how silver has responded to monetary shifts. Periods of currency debasement, rising fiscal deficits, or declining real yields have not translated into proportional moves, suggesting that other forces are counteracting those pressures. Market behavior implies that these forces are increasingly artificial, maintained through positioning rather than organic balance. When such counterweights weaken, repricing tends to be abrupt rather than incremental. There's also the matter of timing mismatches. Financial markets operate on expectations, while industrial demand operates on necessity. As silver becomes more embedded in critical technologies, demand becomes less price sensitive, reducing the effectiveness of suppression through financial channels alone. If procurement continues regardless of price, the burden of adjustment shifts back onto the paper market, where leverage magnifies consequences. What Oliver hints at is not a dramatic break, but a gradual loss of influence. Control doesn't end with a spike. It ends when interventions stop producing the intended response. When selling no longer dampens rallies, or when dips attract persistent buying, the character of the market changes. That transition can unfold quietly, leaving participants to realize too late that the old playbook no longer applies. Another subtle pressure comes from portfolio construction. As correlations across asset classes tighten during periods of stress, diversification benefits shrink. Silver, often overlooked, can suddenly regain relevance as other hedges falter. Even small reallocations can have outsized effects in a market with limited depth, especially when short exposure is already elevated. All of this points to a narrowing corridor where stability can be maintained. Each attempt to enforce calm draws on finite resources: capital, credibility, and liquidity. Once those are stretched thin, the system doesn't announce failure, it simply reacts differently than expected. And when expectations stop being met, markets have a way of teaching lessons quickly, often to those least prepared for the change. For decades, silver's role as a strategic input has been acknowledged in policy papers and procurement plans, but rarely priced as such in financial markets. That disconnect has allowed price behavior to remain subdued even as reliance on the metal deepens. Oliver's warning gains weight when viewed through this lens, because markets tend to misprice assets longest when their importance is diffuse rather than visible. One pressure point lies in inventory behavior. Available data suggests that reported stock levels can remain stable even as accessibility tightens, because ownership concentration matters as much as volume. When metal is technically available but practically unreachable, price signals lose clarity. Financial markets may continue trading claims on silver, while physical holders grow less responsive to marginal price changes, creating a silent divergence that rarely resolves without friction. There's also a temporal asymmetry at work. Short positions benefit from time decay and routine volatility, while long exposure often requires patience and conviction. That asymmetry has favored suppression strategies for years. But when time stops working in one direction, when months pass without the expected retracements, the psychological balance shifts. Positions that once felt safe begin to feel exposed, even before losses become severe. Oliver's framework doesn't rely on forecasts of demand surges or policy shocks. It focuses on structure, how markets behave when stressed systems are asked to do more of what's already failing. If selling pressure no longer produces lower lows, it signals diminishing marginal effectiveness. That's often the precursor to a regime change, not because participants decide to change, but because they're forced to adapt. Another complication is transparency. Modern markets generate vast amounts of data, but clarity doesn't always follow. When participants rely on the same indicators, blind spots become collective. Silver's quiet trading range may be less a sign of balance than of shared assumptions that haven't been tested recently. Once those assumptions are challenged, reactions tend to cluster rather than disperse. As these elements converge, restricted access, eroding confidence, and diminishing control, the system's flexibility narrows. Adjustments that once unfolded over quarters can compress into weeks or days, not because conditions worsened suddenly, but because tolerance finally ran out. And when tolerance disappears, the market's response is rarely calibrated. It's dictated by necessity rather than preference. For decades, the silver market has functioned on the premise that any imbalance can be neutralized through scale. Large players, deep pockets, and layered instruments have given the impression that no single pressure point matters on its own. Oliver's concern cuts against that belief by focusing on how systems fail not from a single shock, but from cumulative strain that reduces the effectiveness of scale itself. One emerging vulnerability is coordination risk. When many participants hold similar positions for similar reasons, diversification becomes an illusion. Short exposure that once appeared distributed can behave as a single block under stress. Market behavior implies that silver's positioning has become increasingly uniform, meaning reactions are more likely to align than offset. In such conditions, liquidity doesn't disappear gradually. It steps aside. There's also the issue of confidence in reference prices. Benchmarks are only stable when participants trust that they reflect real conditions. If physical premiums, delivery timelines, or regional dislocations widen, confidence erodes quietly. Financial prices may continue printing, but their authority weakens. When that happens, market participants start managing exposure defensively, often simultaneously, amplifying moves that would otherwise be contained. Oliver's warning about retaliation is less about intention and more about inevitability. Markets don't push back emotionally, they push back mechanically. When pressure has been applied in one direction for too long, the release doesn't require a narrative. It requires only a failure of response, a sell-off that doesn't accelerate, a rally that doesn't fade, small anomalies that signal a larger shift underway. What makes this phase dangerous is its subtlety. There's no clear moment when risk becomes obvious. Instead, a series of minor adjustments accumulates until the market's behavior no longer matches expectations. By the time participants acknowledge the change, positioning has already lost flexibility. As silver approaches that inflection, the system faces a narrowing set of outcomes. Either balance is restored through controlled repricing, or adjustment is forced through disorderly movement. History suggests that when leverage is high and patience is low, the latter becomes more likely, even if no one intends it. And once that choice is made by the mechanics of the market rather than its participants, control becomes a retrospective concept rather than a present reality. For decades, the final stage of market stress has followed a familiar pattern. Denial gives way to surprise, surprise gives way to reaction, and reaction gives way to explanation after the fact. Silver has not yet entered that sequence, but Oliver's analysis suggests it may be approaching the threshold, where behavior changes faster than narratives can keep up. At this stage, the most telling signals aren't dramatic moves, but inconsistencies. Rallies that hold longer than expected. Pullbacks that attract steady buying instead of aggressive selling. These aren't confirmations, they're warnings that the internal logic of the market is shifting. When familiar strategies stop producing familiar outcomes, risk models begin to lag reality. Another pressure point emerges in funding and collateral dynamics. As volatility expectations rise, even modestly, the cost of maintaining leveraged positions increases. That pressure doesn't need a price spike to matter. It works quietly through margin requirements and internal risk reviews. Short exposure becomes more expensive to carry, not because it's losing, but because it's becoming harder to justify under tightening constraints. Oliver's concern centers on how quickly this phase can transition. Once defensive behavior sets in, decisions compress. What once could be managed over weeks becomes a matter of days. In thin markets, those compressed timelines magnify impact. Liquidity isn't absent, but it becomes conditional, appearing only at prices that feel discontinuous to those anchored to recent history. There's also a reputational dimension that rarely gets discussed. Institutions don't just manage risk, they manage perception. Being early is tolerated, being wrong at scale is not. As uncertainty grows, incentives shift toward reducing exposure rather than defending positions. That collective instinct can overwhelm individual conviction, especially in markets where exits are narrow. What this leaves is a market poised between inertia and adjustment. Nothing has broken yet, but nothing feels as stable as it once did. Silver continues to trade, numbers continue to print, and systems continue to function, even as the assumptions holding them together are tested incrementally. And when those tests finally exceed tolerance, the response won't look like a prediction fulfilled. It will look like a system reacting to constraints it can no longer ignore. For decades, the most consequential market shifts have occurred not when danger was obvious, but when stability was assumed. Silver now sits uncomfortably close to that territory. Oliver's warning isn't framed as a forecast of prices or dates, but as an assessment of resilience, how much strain the current structure can endure before its responses change character. At this point, the system is relying on consistency. Consistent behavior from traders, consistent access to liquidity, consistent confidence in mechanisms that have worked before. The risk emerges when just one of those elements falters, a hedge that's reduced instead of rolled, a counterparty that steps back instead of absorbing flow. These are minor decisions in isolation, but in aggregate, they redefine the market's center of gravity. What's striking is how little incentive exists to reverse course proactively. As long as prices remain contained, the costs of maintaining exposure feel manageable, and the rewards of staying the course appear intact. That creates a collective action problem, where everyone benefits from stability, but no one wants to be first to acknowledge that stability may be conditional. Oliver's analysis suggests that this delay doesn't prevent adjustment, it concentrates it. Another factor is narrative lag. By the time explanations emerge, supply constraints, demand shifts, technical breaks, the adjustment has usually already occurred. Markets move on mechanics first and stories second. In silver, those mechanics are heavily influenced by leverage, timing, and the assumption that reactions will mirror the past. When that assumption fails, the move doesn't need validation to continue. The idea of retaliation, in this context, isn't dramatic. It's structural. Pressure applied over long periods tends to express itself abruptly, not as revenge, but as release. When control gives way, it does so quietly at first, then all at once, leaving participants to reassess exposures they believed were neutral. Silver hasn't crossed that line yet. But the conditions Oliver highlights suggest that the margin for maintaining the current balance is narrowing. The system can continue as it is, but only if every component behaves as expected. History suggests that expectation is rarely rewarded indefinitely. For decades, silver has been managed as a problem that could always be deferred, a market where imbalance was tolerated because resolution never seemed urgent. What Michael Oliver's warning brings into focus is not a countdown, but a limit, the point at which deferral stops working and structure begins to answer for itself. Nothing in the current setup requires panic or prediction. The market can continue operating, prices can remain orderly, and narratives can remain calm. But beneath that calm sits a framework that depends on cooperation, liquidity, and confidence, all holding at once. When those conditions weaken together, the system doesn't negotiate, it adjusts. If a retaliation unfolds, it won't arrive as a headline event or a dramatic rupture. It will emerge through mechanics, positions forced to respond, liquidity retreating, price reacting faster than explanation. By the time the shift is widely recognized, it will already be embedded in behavior rather than theory. Silver's significance has always been underestimated because its stresses build quietly. That hasn't changed. What has changed is how little room remains for those stresses to be absorbed without consequence. Markets rarely warn loudly before they reprice. They simply stop behaving the way participants expect. And when expectation fails, the move that follows doesn't feel like surprise in hindsight. It feels inevitable.